Bismillah ar-Rahman ar-Rahim. Assalamu alaikum everyone. I am Hussain Qazi, the facilitator for ACCA subjects SBR, AFM and FM. Now this particular video is about the discussion related to proposed amendment related to IAS, International Accounting Standard 8. So candidates, very specifically IAS 8. Based on the regular studies, IAS 8 is about to deal or about to support us whenever the company facing the issue related to change in accounting estimates or the change in accounting policy or any errors that impact prior periods. So very categorically, any error related to prior period and change in accounting policy that's impact retrospectively with the principle of consistency. For example, if the company implemented some new accounting policy, for example, for the sake of that matter, to make better presentations, shift from one policy of FIFO inventory to FCO. So based on this, if the company changed the accounting policy for the better information presentation, considering the business model, so that impact of the current year accounts, for example, let's say 2020. So 2020 accounts must be consistent with 2019 for the comparison. And same case applicable if some error arises related to a prior period. But candidates, on the other hand, what about the aspect related to accounting estimates? The accounting estimates, for example, change in the depreciation method, let's suppose. So, or the valuations, judgments, these estimations impacts prospectively, having the effect of prospectively in the accounts. So coming to the specific point, this current development is specifically about accounting policy, change in accounting policy. So what's the proposed amendment about? You must have to aware about that. Whenever a company, for example, let's suppose finalizing the accounts 2020 and facing the issue of the change in accounting policy. So in a practical world, the retrospectively effect is a very challenging matter in two aspects. Number one, very time consuming, very complex issue. And number two, costly solution. I mean, this is a very cost, we require the heavy cost for this to get to gather the data and the human resource, and specifically the technical human resource like the chartered accountants and the ACCA qualifiers, like these persons deputed different number of hours, or even sometime approaching to the consultants. So this is a very costly this is very costly activity. So the question is that the time consumption and the cost incurring, it's really advantage to the user of the financial statement. It's really beneficial for the making of the financial statement. So this is what about the issue. This is what about the issue. So initially, a very quick introduction about it. The proposed amendment. The amendment are intended to facilitate voluntarily change in accounting policy that result the agenda decision published by International Financial Reporting Standard Interpretation Committee, IFRS Interpretation Committee. I will explain the sequence just after a couple of minutes. But here, before entering in a detailed manner, first of all, make a quick review, a quick reminder. of the IAS 8. In accordance with IAS 8, entities should only change accounting policy. When the accounting policy change, consider if required by the standard. For example, shifting from IAS 17 leases by the lessee. For example, lessee accounting. Since I have been engaged with the lessee accounting, for example, my company engaged with the lessee accounting since 2012. But in 2015-16, the change arises related to IFRS. The leases convert from IFRS IAS 17 to IFRS 16. So now the lessee accounting have to change because accounting standard become change. Now become the right of use assets. So if the accounting policy change that's required by the standard, or like I said to you earlier, start of the session, that result in more reliable and relevant information of the financial statement. If the company considered that we move from one policy to another policy, for example, the accounting standard has already given the option, let's suppose IAS 2, FIFO or FCO. So we have been using since 10 years the FIFO, but the business model has changed, and the company management has realized that the FCO is now the right method for the reporting, for the better and the relevant, reliable informations to the user. So they have moved towards the another policy. Same case, for example, the revaluation to the cost model, cost to the revaluation in IAS 16 or IAS 40, like this, considering the consistency approach as well. So these two these two aspects need to consider, either required by IFRS or by the relevant standards. But in any of the case, if the change in accounting policy arises, so ideally, once we say that when the change is not, ideally, it's implemented retrospectively, ideally, until unless particular standard required another point. What says standard, when a change is required by IFRS, then the standard normally specified transition provision. Sometimes the standard says, for example, IFRS 16 lessee accounting change from IAS 17 to IFRS 16. So that specifically specifies some transition provision or optional provision. I'm not discussing right now here. That means the impact of accounting policy, change in accounting standard, and particular mention by the new lease accounting, number one. Or if not mentioned accordingly. So we will, by default, when the change is not required by IFRS, then by default, it's a by default. It is implemented retrospectively, unless impracticable to do so. Unless impracticable to do so. Means ideally retrospectively. If impracticable to do so, then we cannot apply the retrospectively. For example, we are moving towards cost to fair value model. Cost to fair value. So sometimes it's very difficult to identify previous year reliable fair value estimations. So since 10 years, we have been engaged with the investment property with the cost model, but now, or the property plant equipment with the cost model. But we have now, the management have decided to move towards the all investment property, all property plant equipment move toward fair value model. So now the year is 2020. So here's the challenge, that if you apply the retrospectively, so in 2020, the current reliable information available for the for some buildings, for example, they are remote areas, but it's very difficult for that particular remote areas properties to identify the previous year reliable information of the fair value. So that's called impracticable to do so. So this is what the quick review of the matter. This is a quick review about the change in accounting policy. On the other hand, if this is about change in accounting estimates. For example, application of depreciation is accounting policy, but depreciation method is estimates. Provision estimates, that's prospectively. If there are some changes, that's apply prospectively, no impact retrospectively. So that is a quick review about it. But our concern with this proposal is specifically about um, change in accounting policy. So there is a problem arise. There's a problem arise back in 2017-18. And problem is what? That's I've already discussed earlier. Calculating prior impact of the accounting policy change, costly, time consuming. So board is concerned that retrospective application discourage entities from voluntarily change accounting policy, even though change would be beneficial user of the financial statement. Sometimes, for example, there's right now we are sitting in the board meeting and we are discussing that we need to shift our accounting policy from one method to another method. But on the other hand, one of the board candidates says that, okay, this is good for the change in accounting policy, but this is very complex. This is very complex. The issue is very complex to apply retrospectively. That is time consuming or costly. Although the beneficial for the company is that, or for the user of the financial statement, that we move, for example, FIFO to FCO or FCO to FIFO. But this is very time consuming and costly, specifically for the prior period. So if standard allows us, try to understand this point. If a standard allows us to choice between the policy, so that is voluntarily. We can use the term voluntarily. It's our option. It's our consent. Either use one method or other, either cost model or fair value. It's voluntarily, but this voluntarily may overshadow upon the benefit of the statement of the financial statement. If they consider that if we move from one method to another method and the another method is beneficial, but the constraint is the retrospectively costly and time consumptions. Cost issue and the time consumptions. So that is the problem area. So this problem area highlighted by, this statement is important, highlighted by some stakeholder, an approach to accounting standard board and international financial reporting standard interpretation committee. Approach to committee. We need to, stakeholder says that, for example, group of companies or group of industries make an application, and submit it to IFRS committee to resolve this issue. We wanted to apply the best accounting policy with our own, especially for the voluntary method, voluntary options. But the constant is time consumptions and the costly, so need to allow some solution. For example, that's something about prospectively issue rather than retrospectively. So approach to IFRS first, IFRS committee first. Then IFRS committee issued an agenda decision. And then based on that agenda decision, board published a document called exposure draft. Let me clear more thing. Number one, what is the role of IFRS interpretation committee? Role. What is that role? What's the role? Do remember, International Financial Reporting Standard Interpretation Committee is independent of International Accounting Standard Board, also the part of one project, that is IFRS, but they are independent work from International Accounting Standard Board. International Financial Reporting Standard Committee, only the purpose of International Financial Reporting Standard Committee is to publish the interpretations, clarifications, or some agenda proposals, agenda decisions. That is not the part of IFRS. If they consider that, if the board consider that the issue is important, then board has a right to issue the discussion draft, then exposure draft, and then change in IFRS. So do remember, International Financial Reporting Standard Committee don't have the scope to change accounting standards. So what's the role of IFRS committee? The role is to respond questions about the application of IFRS standard that is submitted by stakeholders. If the committee concludes that the existing IFRS is adequate, means for example, a stakeholder approach to IFRS committee, then IFRS committee, interpretation committee, evaluate the situation and finalize that the situation is right, means in all contexts, some complaints or some proposal made by stakeholder, but interpretation committee feels that existing IFRS is adequate, then publish agenda decision to stakeholder. What is mean of agenda decision? Agenda decision is basically about some interpretation, some convincing document. That's called the details, the reason why IFRS does not require revision, and also explain how best apply the standard. So this agenda decision therefore provide helpful guidance and practice. Helpful guidance and practice. So in the case of IAS 8, same thing happens. Some stakeholder approach about this retrospectively complexities related to cost issue and time consumption. And the same thing published by agenda decision published by IFRS committee. The IFRS interpretation committee consider issue raised by stakeholder relating to application of IFRS. After considering issue, they publish agenda decision with explanation note or explanation material. The explanation material, this is important, is to facilitate consistency in application of IFRS. As agenda decision not authoritative, entities are not required to change accounting policy response, but can do so voluntarily. Means in IFRS committee suggests that if you wanted to change an accounting policy and you consider that this is not cost effective, that retrospectively effect is not cost effective, then you can apply as prospectively. This red line is very much important. As a result of agenda decision, entity may wish to change an accounting policy but be deterred by time and cost involved in retrospective application. Means change in accounting policy, retrospective application, but have to consider the time and cost matter. If really cost benefit in the cost benefit analysis, it's a very costly solution, then ignore retrospectively and move on for prospective issue. But do remember, IFRS committee don't have a right to declare any change in accounting standards, but they just interpret the things based on the constraints, and in a very light manner they uh, explain the interpretation. So based on this agenda decision, ISB, which has a right to change the accounting standard, but in a sequence manner, first the discussion draft, then the exposure draft, then the change. Publish the exposure draft, proposed amendment of IAS based on the agenda decision I discussed above. And what they said, ISB has proposed limited scope amendment of IAS to IAS intended to facilitate voluntarily change in accounting policies result from agenda decision. Means ISB wants to endorse the material statement or the agenda decision made by IFRS interpretation committee. And the board proposed that accounting policy change should be implemented retrospectively unless this is proposal normal. Till now I said just this. The board proposed that accounting policy change should be implemented retrospectively unless impracticable to do so. But the proposed change is retrospectively application unless it is impracticable to do so. For example, lack of data. And this one is important. Cost of working out the effect of change exceed the benefit to the user of the financial statement. Means make a cost benefit analysis. If cost incurring about the retrospectively effect greater than the benefit you will get, then the implementation will be made prospectively, not retrospectively. This is the point. Read it. If entities' cost of determining the period specific effect or cumulative effect of the change exceed, means cost exceed the expected benefit to the user of the financial statement, new accounting policy need to be applied, not to be applied retrospectively, but prospectively. That is the proposed amendment. Examiner definitely can examine you about this. I have already told you with my last video that examiner only can examine about the basic principle, not in very much detail. Number one. Number two, the very important thing, not the comprehensive question, only the limited questions. But you must have to aware that what are the deficiencies in the existing standards. You must have an ability to explain it. So before discussion about the deficiencies, about the cost benefit analysis, the board also proposed that the entities considered in the cost benefit analysis, for example, the magnitude of the change. For example, whatever the change required, what the dimension, what the magnitude, what the extension of the change, and what the effect on the trend information. Have to consider this point as well. Lastly, candidates, I strongly suggest that you people must have to know that what are the particular deficiencies right now in the IAS 8. It's a very simple matter. Right now, IAS 8 allow the entities to develop retrospectively impact and change the comparatives here statements. For example, in the case of the errors. So this is what a loophole. We can consider that this is what a loophole means. Some of the management may deliberately use this option. This window is open for window dressing. So in this case, preparer or entity of the financial statement preparer of the financial statement could use this treatment for prior period errors as a method of manipulating current period earnings. It may possible that, for example, as a director, some management deliberately make some errors in 2019. With that aspects, we will move 2020, and then we have a plan to identify the mistake in the next year. And when next year 2020 happens, we declare that some prior period errors occurred. So that's why we have to change the prior period as well as impact on the current year as well. So this is what this option, if this option opens, so this can also be used for the manipulation. That's the key point. Furthermore, as we have already discussed, retrospectively impact of the accounting policy, time consuming and costly. You can write it accordingly. And very important thing, you people have to notice one point. Sometimes it's very confusing that is this the accounting policy or the accounting estimates? Although the definition exists about the policies and estimates, but they are vague. They are not clear. Sometimes it's very vague in the aspects. Accounting policy and accounting estimates. If we mix, or if we haven't applied right in a right manner about that something is accounting estimates, or we have considered that accounting policy, so it may possible that we have incorporated the impact prior period, but in fact that should not be. So these are the matters. So thank you very much, candidates. You have to read this document accordingly. You can you can find this video from my YouTube channel, and further videos I will upload for more current development aspect. Thank you very much. Take care a lot. Assalamu alaikum.